Want to own a high-quality tech stock? Looking for a tech stock that isn't too expensive right now? Would you like to buy into a high-quality technology business and collect market-beating income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you enjoy our videos. It helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividend. These growing dividends are funded by growing profit because this business is providing the world with high value technology products and services. In fact, this company's products are necessary for the infrastructure of global networks. You probably wouldn't be watching me on your computer right now without these products. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay. Value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Cisco Systems Inc., which appear to be trading at a significant discount today. Cisco Systems Inc., stock ticker CSCO, is the world's leading designer, manufacturer, and supplier of data networking equipment and software. Founded in 1984, Cisco Systems has grown into a $197 billion by market cap tech giant, employing over 75,000 people globally. The company operates across 5 groups: infrastructure platforms, 58% of fiscal year 2019 sales, services 25%, applications 11%, security 5%, and other products 1%. Cisco Systems is essentially an investment in tech infrastructure. Without that infrastructure, you're not able to jump on the internet and watch this video. It's the major supplier of switches, routers, firewalls, and supportive networking products. The company's various products and services are vital for network performance and security. And as the internet morphs into the Internet of Things, a ubiquitous interconnection of computing devices into everyday objects, the company's products and services will become even more critical. The importance of these products and services should lead to more profit, and more profit should lead to more dividends. Cisco has already increased its dividend for 10 consecutive years. Sure, not the longest streak around, but what they lack in track record, they more than make up for in growth. The 5-year dividend growth rate is 13.3%, and that's a lot of growth when you pair it with the stock starting yield of 3.1%. This yield is slightly higher than the stock's own 5-year average. With a payout ratio of 56.9%, this dividend is secure and in a position to continue growing. Looking at business growth, Cisco grew its revenue from $40.040 billion in fiscal year 2010 to $51.094 billion in fiscal year 2019. That's a compound annual growth rate of 2.93%. I usually like to see a mid-single digit top-line growth rate from a mature business like this. Admittedly, they fell slightly short. However, the company bought back a lot of stock in order to produce better bottom line growth. The company's earnings per share advanced from $1.33 to $2.61 over this period, which is a compound annual growth rate of 7.78%. That's closer to the kind of growth I'd expect from a company of Cisco's caliber. In addition to buybacks, margins have expanded nicely over the last few years. Looking forward, CFRA is anticipating that Cisco will compound its earnings per share at an annual rate of 3% over the next 3 years. I last looked at CFRA's 3-year earnings per share growth projection for Cisco in late February. It was at 5% then. That was, of course, right as the pandemic was really coming on. I thought that was a fair, if conservative, estimate. Knocking it down to 3% seems to be too conservative in my view. With the work from home revolution, even if only temporary, triggering an acceleration, uptake, or adoption of technology, Cisco is actually positioned very well in this environment. CFRA cites a challenging Chinese market as a key headwind. They also note project cancellations from small and medium-sized businesses. On the flip side, CFRA points to a variety of tailwinds benefiting Cisco. These include rising bandwidth consumption, high demand for data center solutions, and the migration to cloud networking. The pandemic is hurting a lot of businesses, but Cisco actually stands to come out ahead. I see the worst case scenario as the whole thing being a neutral event for Cisco, and that's not bad at all. Dividend growth could certainly be middling over the next few years, but the long-term prospects remain great. Moving over to the balance sheet, Cisco Systems maintains a fantastic financial position. Their balance sheet is a fortress. interest. The long-term debt to equity ratio is 0.43, while the interest coverage ratio is approximately 18. If that's all there was, it'd be impressive, but there's more to the story. The company has more than $33 billion in total cash as of the end of last fiscal year. That covers their long-term debt more than 2 times over. This balance sheet gives them defense in an uncertain environment while also allowing for the opportunity to be selectively offensive. They can be nimble and scoop up fast growth companies by virtue of their immense cash hoard. Their profitability, as one might expect, is extremely robust. Over the last 5 years, the firm has averaged annual net margin of 16.54% and annual return on equity of 15.63%. Great numbers. Again, though, there's more to the story. Fiscal year 2018 was an aberration, artificially lowering the averages. In truth, Cisco is routinely showing a net margin of over 20%, which is fantastic. I see this as a great business that's positioned about as well as they can be. Patents, technological know-how, the necessity of their products, and switching costs are all durable competitive advantages for the company. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The very nature of the business model is also a clear risk, as technology changes very quickly. As a big enterprise player, Cisco is exposed to the pandemic, and the souring of US-China relations have been, at times, centered around technology. This creates unusual geopolitical risk. Overall, I don't see Cisco as a high-risk investment. At the right valuation, this could be a very intelligent long-term investment. Well, the valuation looks pretty compelling here. The PE ratio on the stock is just over 18. It's difficult to compare this to the stock's recent norms. GAAP numbers have been volatile and cause fluctuations in the PE ratio. However, that is well below where the broader market is at. In addition, the price to cash flow ratio is less than 13. That's pretty favorable in comparison to the stock's own 3-year average price to cash flow ratio of 14.3. And the stock's yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That dividend growth rate is lower than the company's own long-term growth for both earnings per share and its dividend. With a moderate payout ratio and a lot of cash, there's a massive runway in place for dividend growth. However, I'm also factoring in CFRA's near-term earnings per share growth forecast, as well as broader challenges on the enterprise side. I think it's certainly plausible that Cisco grows its dividend at a rate higher than this, but I think it makes sense to be cautious. In my view, dividend raises over the next few years might be on the low end, with things picking back up again within the next 12 to 24 months and averaging out nicely. The dividend discount model analysis gives me a fair value of $51.36. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Cisco as a 3-star stock with a fair value estimate of $48. CFRA rates Cisco as a 4-star buy with a 12-month target price of $52. I came out very close to where CFRA is at. Averaging the 3 numbers out gives us a final valuation of $50.45, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Cisco Systems Inc. is a high-quality tech company with excellent fundamentals across the board. With a market-beating dividend, a moderate payout ratio, double-digit dividend growth, a lot of cash on the balance sheet, and the potential that shares are 9% undervalued, this could be a rare opportunity to pick up a quality tech stock at a discount. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, be sure to check the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. If you think this is something that you could benefit from as well, check the link in the description, see my portfolio, and start getting my buy and sell alerts. I'll see you next time.